Welcome to Great Quarter Guys, episode 10. And it's the podcast where finance meets freight and transportation. And we're live today on social media. So we'll kick it off. My name's Kevin Hill and Andrew Cox here as my co-host for Great Quarter Guys. We're part of the Freight Intel group here at FreightWaves. We research everything logistics. We're basically the proprietary research desk, and we publish our research in Sonar and sometimes on FreightWaves. How are you doing today, Andrew?
I am lovely. How you going, Kevin?
Are you ready to kick off 2020? I guess we kicked it off last week, but this is really the first
proper,
full week, proper kickoff.
That's right.
And send off for 2020.
That's right. I'm very excited.
Very good. And today we're going to talk about still the backbone of civilization and the United States and steel makers and steel tariffs a little bit. But mostly it's about an acquisition that was announced on December 3rd of 2019. So just a little over a month ago. It hasn't closed yet, but there shouldn't really be any issues of that closing. But it's a company called Cleveland-Cliffs. CLF is the ticker. And they announced to acquire AK Steel. So AK Steel goes by the ticker AKS, and Cleveland-Cliffs is an iron ore miner. So they have some mining locations in northern Minnesota and also northern Michigan, and they mine pellets.
They make a lot of pellets.
They make a lot of pellets. So they make a lot of pellets, and they sell those to steel producers like AK Steel, which is one of their customers, actually, one of their major customers. And this feedstock on iron ore pellets is used to make all kinds of steel products from, I guess, pig iron to kind of the composite steels that the Ford and Chrysler and other automobile manufacturers produce. So, Cleveland-Cliffs, they do about $2.2 billion in annual sales. AK Steel is much larger on the sales side. They have about $6.2 billion in 2019, 2018, actually trailing 12-month revenue numbers. So you think that AK Steel is a much bigger company, but on the EBITDA side or operating margins, 30% operating margins for Cleveland-Cliffs, the miner, and the steel producer is only about 5%. So
the EBITDA is almost identical.
Almost identical, right? So each of them are around 500 million EBITDA per year. So the deal will double that. But it's an all-stock transaction that is coming through. I think that the new entity will still retain the CEO from Cleveland-Cliffs, and Cleveland-Cliffs, or Cliffs, I guess, is the short names for that. Cliffs will retain 68% of ownership, and AK Steel shareholders will have 32%. Right. And it will be a vertically integrated steel company. So,
they're expecting now to have the highest margins of any U.S. steel producer, the combined entity. Kevin, let's dive in. Why would Cliffs go after this acquisition? We do know that the value of AK Steel has fallen sequentially for the last couple years. They're about half of the value that they had 2 years ago. But why would Cleveland-Cliffs go after a company like AK Steel?
It is. So basically you have Cleveland-Cliffs. Market cap is $2 billion or $2.1 billion as of Friday of last week. Trailing 12-month revenue is $2.1 billion. So right at 1 times revenue is their valuation. And we mentioned earlier that they have that 30% operating margin. AK Steel has a market cap of $984 million as of a couple days ago, and that is about half of what they were in the beginning or January of 2017. So they've fallen in value for a half. So I like to buy things on sale.
Yeah, we know you're the value guy.
The value guy, right? So Cliffs is maybe making a little bit of a value play. There's another angle in that is much more interesting. They both have long-term debt of about $2 billion, although Cleveland-Cliffs, I think their interest rates average in the low fives, and AK Steel's about 7.25%. And as I said, 2-year stock returns, Cleveland-Cliffs or Cliffs is down about 15%, and AK Steel is down 50%. Now, the short interest, which is always interesting, right?
Yep.
The short interest, not too much in AK Steel, of course, because they're being targeted and acquired, so you don't want to short a stock that is theoretically getting a premium on the market, but Cleveland-Cliffs is 40% short interest. So that means that 40% of their outstanding shares that are floating around are held by short sellers. So there's a huge negative bet on Cliffs.
Yeah, I mean, it's kind of a long-term trend in the U.S. with steel having fallen off. That's one of the reasons that Donald Trump ran on the steel platform, that he's going to bring steel production back to America. So there's these long-term trends of steel plants and of shutting down over the last few years. So.
And then the tariffs that worked in 2017, or the tariffs that were implemented, worked. Certainly in the short term. And it mirrors trucking really well, because you had that surge of production. You have all these mothballed steel mills that U.S. Steel and Steel Dynamics and AK Steel were bringing out and gearing up again. And what happened, just like in trucking, everyone went out and bought trucks.
Overcapacity.
Yeah,
flood the market with steel. Prices come down.
Right. So there's a little bit.
Hurts.
Yeah, there's a little bit of. I think it was Brazil and Argentina got hit with steel tariffs in the last few weeks. So there's a little bit of a bright spot. Steel prices have rebounded a little bit, just like trucking. Right. Trucking has rebounded a little bit, but it was a rough 2019, as you can see with AKS's or AK Steel's stock price that halved. So now Cliffs is buying them up to get into the steel business. So this is a vertical integration. Cliffs supplies AK Steel with iron ore pellets. Right? So they supply, they don't produce steel, right? Although they are kind of creating a plant for, I believe it's pig iron. Still in
Kentucky
Dayton,
or Ohio, one of the
Dayton
two.
or Toledo, Ohio, somewhere in Ohio. And so you have this very interesting dynamic that now Cleveland Cliffs, what are their top 3 customers?
Yeah, so they've got 3 customers that make up 95% of their sales, which is just it's asinine to me. I haven't ever heard of a company making up, like a public company, in that making up that high of a percentage just out of a handful of customers. So that's it's a lot of risk.
It is a lot of risk, and basically, with that said, Cleveland Cliffs has a nice moat around their business, which is the Great Lakes.
Yes,
I don't think that's a pun.
Quite literally.
quite literally, the Great Lakes, where that they actually can't ship via barge across the Great Lakes this time of year. So that they kind of hold inventory in northern Minnesota and also the southern ports of basically Cleveland and around, the Great Lakes and Ohio, which are their southern ports. Right?
And AK Steel was a massive customer of theirs. They were one of those 3. They made up 25% of their sales. AK Steel did. So there's a vertical integration and there's some synergies there. But you could lose a little bit of the margins if you're selling to your now subsidiary.
That is, but
it's kind of a risk
if you think about iron ore pellets in the Midwest, right? That's where the heart of steel country lies. There's not that many players out there that you can really supply, and I think they had some joint venture agreements over the years with some of their top customers. But AK Steel, so their stock price is cut in half over the last 2 years. They have $2 billion of debt at a very high coupon. Wall Street, while they have a very low short interest right now, they're not a lover of AK Steel returns, right? So you have that, and then you have contract negotiations. So basically, Cliffs sells to those 3 customers in long-term, fixed, commodity-based contracts, volumes and tons and all that great steel talk. But what you have are contract negotiations coming up in, was it 2022?
Yep, and 2022, 2023.
2020, where they're going to start renegotiating all of their pricing. So is part of this, is a large percentage of this, is this a bailout number one, is it a bailout of AK Steel? And number two, is it kind of mitigating those risks of knocking out 25% of their revenue and also renegotiating those prices?
Yeah, I mean, yeah, like I just said, I think there is a risk of losing some of the margin, but I think that there's a win-win for both sides here. One, you have Cliffs, who is worried about losing a quarter of their revenue to AK Steel, who could possibly go bankrupt and default on their loans. And then you also have AK Steel, who's looking for a solid supply of iron ore all the time, and now they have one. They never have to worry about another supply. They have one of the biggest suppliers in the country in Cliffs, so there's a win-win in both. It's a bit of a bailout because AK Steel's they're hurting. They're in trouble right now.
That they are, but they're not in.
But they're not in Chapter 11 anywhere near
they're
that.
not even. They're not even near that.
No.
But are they a healthy, growing company, or either of them actually healthy, growing companies? And I don't think so.
No, I don't think so either. The truth is that yes, we use steel in almost all of our manufacturing products, but manufacturing has been in a massive slump this year. They're going to need to, try to pivot towards some of these higher value added products, which there's a dozen acronyms for these steel products that I haven't memorized, but there's the American high strength steel. Yeah, quite confusing. But and these auto manufacturers in the U.S. are starting to shift towards these lower weight, higher value steels. One for environmental reasons, and two because they're trying to make safer cars. And
it's a very interesting point there, right? So basically, you have this acquisition coming in when North American auto sales are peaking, right?
Yep.
And 63% of AK Steel's business is to the automotive industry.
Yeah, which is like more than double any closest industry peer.
More than double, right?
Wait, what do you think about that, by the way? You think that's a risk, or that's a competitive edge, or a little bit of both?
I think it's a little bit of both. So the risk part is that auto sales are plateauing for this cycle.
Right.
Right. You're not seeing strong growth, but what you are seeing, and you just mentioned it, is the strong growth in the lighter steels. I don't think they're composited. Yeah. But the lighter steels that are better for fuel economy or tougher, right? You're seeing so basically, even though that sales are plateauing, you have sales are plateauing, but you have this
you have a mix of
you have a
new mix of
the
steel
mix,
that's coming in that has a higher margin for both.
So you have redesign of your current cells.
Correct.
Right, you're going for your traditional, fenders and auto bodies into something that's lighter weight. So even on year-over-year same cells, right? You can also they're switching out into this new grade of steel. So that the risk is the plateauing cells, the shifting of mixes of the steel that's used in auto manufacturing is the opportunity.
Yeah, it's growing really. I mean, in the Cliffs investor presentation from Q4, when they spoke about the acquisition, they estimated a CAGR, a growth rate of 14% of these new steels being put into automobile production over the next, I think it's 10 years or so. So I mean, there's massive growth in these high value steels if you can win those contracts.
So and another interesting point is that Cliffs is a miner.
Yep.
They mine iron ore from the ground. Now, that's a very different business, even though that their customers produce steel for the auto industry and construction infrastructure. That's a much different business than mining.
Yeah, I mean, giving a trucking example, it's like if you're a rubber producer and it's also like producing rubber or running a trucking company. Yes, you need tires to run your trucking company, but does anybody that produces rubber know how to run a trucking company?
I don't know.
It's
the same way around.
Yeah,
too,
exactly.
Right?
Same thing here. It's an iron producer. Now they're going to have to create be a metals and metal producer. So what's the trade-off? Do you think they can do it?
That's just one of the threats and opportunities, right? So can they really do it? That they have a strong CEO. He's turned around a couple other companies. He's a little bit outspoken as well. Sometimes
what CEO isn't?
He challenged, I think he challenged a Goldman Sachs analyst in a call to maybe a fight.
Oh.
I mean, I don't know.
If he's a Midwestern steel iron miner, you can only imagine.
But and part of their growth story, so the sliver of growth in this is mostly about efficiencies, right? The sliver of growth, and then we'll get into the synergies, which are astronomical, really. We'll get into the growth story. Is AK Steel has basically mothballed a pig iron plant in Ashland, Kentucky,
Mm-hmm.
and and Cliffs wants to reopen that. They're basically it's kind of the same manufacturing process as their Ohio plant that they're planning to open this year, I believe, sometime
Correct.
2020, maybe 2021. And what you have is, in essence, that they want to open up that to guarantee supply of their iron ore and also for growth for AK Steel. Now, that plant shut down because of customer trends, customer demands, basically shifting away from that facility. Can they bring them back in?
Yeah,
and that's really what it boils down to.
Yeah, and they believe, I believe I read in their investor presentation, they believe they can save $60 million in not closing down this plant. And that's beyond if they can get it towards a profit, a margin that they can make in the coming years, but just saving themselves $60 million and not the upkeep and the maintenance of the place with it not being open. So that's one of the major, not quite synergies, but cost savings that they can get. And then moving to the synergies, they're also large, astronomical, if you want to call them. They, they have the debt that they're looking to refinance from the Credit Suisse. Gave them another $2 billion in debt to on an asset-based loan to refinance the 2023 debt that AK Steel has, which I think they owe. I think got $400 million coming up in 2021, 2022, and 2023, each of the 3 years. So they have a large debt. But one thing that's really good is that Cliffs doesn't have any debt to pay out for the next 4 years, so they kind of have a little bumper there.
That they do, and if you bring that $4 billion of debt load for the combined company, and you shave 200 basis points off that, then you're talking about what is that per year? I knew it before I walked into the booth.
A lot.
It is
Hundreds
a lot.
of millions. And if you're looking at
50 million, I think.
Yeah, over the course of a couple of years.
Yeah. So it's great interest savings. Now, on top of that, they have $120 million in cost synergies that are broken into. So, and 40%, or not 40%, but 40 million of those cost saving synergies are wrapped up in basically just the expenses of operating a public company, auditing, SEC reports, financial kind of, quarterly reports that you have to do. So if you tack on 120 and then another 50, you might get up to close to another couple $100 on your EBITDA per year, and you're buying that at really less than $1 billion.
Yeah, which
is 5 times just on the synergies. So it makes a lot of sense. I know a lot of people, especially in the financial press, are kind of down on vertical integration. And I know it's kind of tough because you mentioned margins earlier that they want to, I think they're projecting out about 15% margins, which would be the highest margin of any steelmaker. But whenever you start doing transfer pricing, which is basically one subsidiary selling to another subsidiary of your company, things get
they want a little extra help on the deal, right?
Yeah. So you can make up your margins over here, but if you start shrinking the iron ore pellet margins, your customers might want to push back on pricing a little bit, and you've just kind of shot yourself in the foot a little bit, right?
Yep. I do want to talk just a little bit more about the AK's their customer base. We talked 63% of their customers are automotive. And to me, it's one thing that the two biggest of those are Ford and Chrysler. And if in my mind, those two companies are they're struggling.
Of course, they're auto manufacturers.
Yes, but there's some autos that have been able to would make it through, whether they're Honda or Toyota, some of the Japanese brands. But I don't know if I'm AK Steel, I'm looking to diversify away from 63% of my sales being from automotive.
But is there that much business out there besides automotive for them?
Apparently, they're one of the main one of the only American producers of the steel that goes into the electric grids.
That's right.
So the infrastructure. I would look towards like trying to get a government contract or some sort of public
Sure.
contract.
Sure.
Those are usually pretty,
Sure.
you know.
And
lofty.
they're very focused on the Midwest too. AK Steel. So basically, they have some like in Windsor, just across the bridge from Detroit, and a couple of Southern Ontario plants, and one down in Querétaro, or in Mexico, kind of where most of the autos are produced down there.
Right.
But other than that, all their facilities, I think they have 15 facilities, and they're all in Ohio and Indiana.
Yep.
And I have a list of them here somewhere.
Yeah, there's one in
my
Alabama.
PowerPoint.
And that's it.
Yeah.
Most of the other ones are right there in the heart of the of
Alabama.
the steel.
Yeah, they're the heart of steel.
belt.
So basically, they do a lot of local loads, and I know that from my experience as a freight broker. Right, they do, of course, the coils
Mm-hmm.
and some plated things, but mostly coils and some curved steel. But yeah, so basically, they're usually shorter runs. 300-400 miles would be a longer run for them, and they service the manufacturing plants. As you can tell from Ford and Chrysler in the Midwest, so Ohio, Michigan, Indiana type of auto plants, and they do some heavy haul things. But I think maybe transporting the steel outside those regions, maybe to the Mid Atlantic where some manufacturing is, or down here, even in Chattanooga, Tennessee, is maybe cost prohibitive, uncompetitive.
Yeah, maybe so.
Yeah.
Maybe so. Let's talk a little bit more about the transportation angle there. We spoke a couple weeks ago about, a lot of these companies don't disclose their transportation spend, but we can do a little, back of the envelope guess. We think, we know AK Steel has like $6 billion in sales. Is that
Yeah,
ballparking?
6 billion sales.
So
We know that.
What do you think
so
the transportation
ballparking
spend
somewhere
would be?
between $400 and $600 million.
Okay, so like
It's
8 to 10%.
8 to 10%. Yeah.
Okay.
So they do a lot of raw materials in, and most of that is, I believe, by rail.
Okay.
So they do a lot of that, especially the iron ore pellets that arrive in the southern ports of Ohio and basically get railed to the mills. That have a lot of flatbed, a lot of open deck loads, a lot of heavy loads coming out of their facilities to their customer locations. They're a huge shipper, and I wouldn't be surprised if they, just on trucking alone, they spend $300-400 million a year. So it's a huge contract. They usually do a lot of managed, dedicated transportation, like a 3PL or 4PL
Right.
provider, and I don't know who has that contract as of now. But they're always looking for capacity. They're always looking for capacity. They're notorious about always looking for capacity in the Midwest for flatbed operators, and they're usually pretty good to work with. It's a very safe operation. Safety is always pretty secure at those facilities. But if you're a carrier, certainly they're a great customer to haul for, and you're a freight broker. The margins can be a little bit thin because the lanes are typically pretty short.
Pretty shorter, yep.
So you're looking at about maybe a $700 load. So there's not a lot of meat on the bone for that. But they do have some longer hauls. They do have some Mexico freight. So it's a good company. It's a good industry for either a carrier or broker to break into. I hold a lot of steel, not for AK Steel, but out of Michigan, Indiana, Ohio, down to Monterrey, Mexico. So you can make some pretty good margins, especially when capacity is tight on flatbed loads. It's just a really good business. On the Cliff side, I think most of it's barge and train.
Yeah, you're right.
I think so, because it's a very bulky item. So it's not going to go into trucks. Really, it's just going to be barged across the Minnesota down to the southern ports of Ohio, and then put on rail
Loaded on the
cars.
train.
Yep, down to specific customers. And when you only have 3 customers, it's pretty easy.
Pretty easy
to figure,
lane, yeah.
But yeah, I know, right? It's pretty easy to figure that out, how to get to those, however many facilities they deliver to.
Right.
Yeah.
Well, Kevin, all in all, is it did they get a steal with AK Steel, or did they get the raw end of an iron deal? What do you think?
I think they got a steal.
Okay.
I think they got a steal just on the EBITDA numbers coming up, or the operating margin. You might have a $1.2, $1.4 billion a year EBITDA company that's going to be valued at $3 billion at the end of the acquisition. So, what's your take on it? What do you think?
Yeah, I'm not willing to call it a raw deal. So I think it is a steal if that's my only two options. I think people aren't always for vertically integrating, but I think these are close enough of a tight vertical integration, and especially if it's not so much of a hard integration. They're keeping both the brands.
They are, yes.
So you have a strong brand in AK Steel. While it has gotten hammered by Wall Street in the last couple of years, it's still a strong company with really big sales. So I think
it helps with leverage, right?
Yeah,
it helps with all the problems AK still has. It helps with that.
Yeah, I agree. I hope they are capable of diversifying away from automobile a little bit, but I still think it's a massive. I mean, they still have a stronghold of automobile steel production. So
I think you go with what got you.
Go with what you know. You're right.
I mean, basically everything's cyclical, but auto sales have kind of peaked on this cycle. But I think the changeover to new materials in automobile, bodies, or a nice growth opportunity.
Yeah, higher margins.
Higher margins. And the company is not an explosive growth company. I mean, it's still a manufacturer and a miner. So it's going to be low growth, very mature. But I think the valuation, I kind of like it if everything goes well.
Right.
But everything can go wrong too. So it's a little bit of a gamble, but it's not quite as gamble as what I thought when I first started digging into the case. So yeah.
Well, cool. What do we got next?
We have our latest research report, but we also have this as well. So we're live on LinkedIn, and if you're listening after this on a podcast or a video, we developed a slide deck to kind of go through the fundamentals of AK Steel and the acquisition, and also some transportation highlights between the two companies. So if you want to email us, khill@freightwaves.com. So that's KHILL at freightwaves.com. I'll send you a copy of this PowerPoint.
Yep, for sure.
Yeah. So, and then we'll dive into our latest research report that we published today, and that is the Q1 2020 Carrier Outlook.
Right.
And this is a survey that we do every quarter of small to medium-sized carriers, usually running from 5 to 100 trucks. So, not small fleets by any stretch of the imagination, but smaller fleets that really there's very little intelligence about guys running these fleet size. Most of the research out there is with the mega fleets, but we always like to know what the attitudes and sensitivities of the smaller fleets are. So we always do, what's your outlook in the next quarter as opposed to a year ago in that quarter. So Q1 of 2020 over Q1 of 2019. Do you think that volumes are going up, down, sideways, rates, diesel? What are the risks in trucking right now?
Right.
Kind of detention time. So Andrew, you want to tell us, where do carriers think rates are going to go year over year in Q1 2020?
They are pretty tepid. They're a bit. I'm not going to call them confused, but we've got.
It's a three-way tie, right?
Yeah, dead split. 33% each way, positive, negative, and neutral. So this is a big change from 6 months ago when we asked this question in Q3 2019. Most people were pretty negative at that point.
They're very negative
after a pretty low, bleak summer.
Yeah. The positivity wasn't that high. It was in the 30s, but the negativity was in the 60s.
Yes,
right.
Highest we've had it.
Yeah. So we bottomed out in Q3, rebounded really well in Q4, which has turned out to be a really good quarter.
Yeah.
Or a good finish to the quarter, at least, with a strong holiday season. But yeah, Q1 of 2020 is just a three-way side.
Yeah.
The three-way tie between the three. So carriers have no idea where rates are going.
No,
not a clue. Not a clue.
I don't know if anybody.
How about rates?
That was volumes?
Yeah, that was volumes.
Volumes.
Rates are about the same.
Rates are about the same too. I mean, it's really every question we asked this time we had we have the highest neutral percentage on any of these as we've had. So I think a lot of people are just kind of in a wait and see mode right now.
I think that's the second headline of it is the largest growth where so we broke these down into positive, negative, or neutral. So on volumes, it's positive for increasing volumes, negative for decreasing volumes, and neutral for staying the same. and it kind of flows through that with each of the questions. But yeah, all three of them, the response of Q2 2020 will be just about the same as Q1 of 2019. That was the biggest mover from Q4. Is
Yeah.
everyone's kind of Sagline or
They're a little bit more positive about diesel prices.
they are, which is surprising.
Yeah,
right.
Especially
Especially-
amid IMO 2020 and amid the Iran. I guess we didn't really know about this, and that
Yeah.
was the weekend after. But
True. We did the survey before Iran, but IMO 2020, which I still don't think a lot of people in transportation have really followed all that much, especially the smaller carriers or freight brokers, and we haven't seen any effects yet. But essentially, it is. Can you?
Yeah. So it's a maritime rule where they're having to switch the diesel that they use. They're going from a high sulfur fuel to a low sulfur fuel, and the components that create the low sulfur fuel are the same that make diesel. Correct?
Yeah.
So you basically have a higher demand for diesel. Middle distillate. Yes.
Yeah.
A higher demand for middle distillate, which could, in theory, put some upward pressure on diesel prices in the U.S.
And you know what? I think it will at some point. It might take an oil spike, like what we haven't seen it with Iran.
But you could if they start bombing, oil producers in the Midwest or the Middle East. Excuse me.
Yeah. So you never know about that. But what it kind of the math works out to where basically if you took 1 million long haul, Class 8 semi trucks, and you switch those to gasoline on January 1st, it would basically create chaos in the gasoline market.
Yes.
Right? With all that added demand flying in.
Mm-hmm.
And the number is about 7% on the diesel market for all the ocean-going vessels who are switching over. So it might take, we were thinking, basically this changeover happened in the fourth quarter between, in the ports, cleaning out and putting in the new fuels. But it might take a little bit longer, and oil's been kind of like all other commodities this year, just kind of low volatility, meandering along, like a river oil. So
there's one question that we always ask that we haven't mentioned yet, and that's your expectations for how much capacity you're going to add in your fleet over the next 12 months. And this has been a point of a conundrum really for us for the last couple. The couple times we've done this survey, because we'll ask them what they think the biggest risk is, and almost always the biggest risk is lower rates, depressed rates due to overcapacity. And then we ask them, now what are you going to do to your fleet? And they all say, we're going to add 25% to our fleet.
I know.
So, it never makes any sense, but that did change this time, and we have the vast majority of people saying they're going to keep their fleet the same. They're in that wait and see mode.
We do, and we've been tracking that all through 2019, and the numbers kind of come down, right? So fewer and fewer carriers are expecting to expand their fleet more and more, or staying pat. But you know what? People contracting or shedding trucks on their fleet has been under 20% all year, and barely moves. It kind of moves from 20 to 15%. So not a lot of trucking companies are looking about slimming down their fleets. It's basically they're going to stay neutral, or maybe add a few trucks here and there.
Mm-hmm.
Yeah.
I wonder how many of the trucking companies don't want to give away their secret if they're looking to sell some trucks. They're like, I know this is an anonymous survey, but
I know, right? But you know what? If you're running a trucking company, you're going to be an optimist, right? You're going to be an optimist, but sometimes it pays to slim down a little bit.
Yeah, I mean, if you have unprofitable miles, sometimes you got to park them.
And basically that's. We always finish off the survey with what's the biggest risk to trucking over the next 6 months, and overcapacity is been the winner for the last 3 quarters. So you'd think that number of trucking companies who are expecting to stand pat or contract on their fleet size would come down as well. So
here I'll go ahead and tell you those top 3.
Yeah.
We got the biggest, most significant risk of the next 6 months. First, depressed rates due to overcapacity, as we just mentioned. The second is lower freight volumes, which it looks to seem to be a good week to start the year.
Yeah, we finished up Q4 10% over where we were in 2018. And Q1,
and
this week we were up 6%.
Yeah, we're looking at depressed comparables. The Q1 for 2019 was not good, but either way, it's good. We'd rather be positive than negative. And then the third is increasing in operating and maintenance costs, which is never fun for anybody.
It is not.
But insurance is likely to go up.
Is insurance part of that?
Or we need to add it, actually.
We do need to add it.
It should be insurance. And,
yeah, because that's going up 20, 40, 50%.
Which kind of leads into
100%
a little throw into our next paper that's coming out soon.
It is, nuclear verdicts,
right.
which will be out very soon.
Yeah,
actually, in the coming days, and just examining the playbook of how to navigate kind of settlements and kind of identifying which cases go nuclear.
Mm-hmm.
Which is what, 10 million and above in punitive damages.
Right. So there's a couple different definitions. Some people just use a dollar amount. Some people do as an X over whatever the medical cost would be, which would be punitive damages.
Yeah.
Right.
Yeah, and a good thumbnail or thumb index on that is anything over $10 million. So
typically,
and just trying to dissect those cases and find out exactly what went wrong and why they were nuclear verdicts. And there's enough blame, I think, to go around to all parties.
Definitely.
Because of that, it's kind of a guidebook or a playbook to navigate through that, and that's available to Sonar users as well. So, going on to the next section, which is the DHL supply chain pricing power index.
That's right.
This week, and where were we this week?
We stayed put. We'll give a quick refresher on what the DHL Supply Chain Pricing Power Index is. It is a quantitative and qualitative measurement that we put out that is kind of looking at the negotiating power between shippers and carriers. They're in a constant struggle back and forth. For the majority of 2019, the shippers were in dominant control, but then there in the last 6 weeks, we had a good holiday season. The carriers started to gain some control, and a 50 would be a balanced market. A 0 would be all the way balanced to, or all the way power to the shippers, and 100 would be all the way power to the carriers. Right now we sit at 45.
45 again for the second week in a row.
Stayed at 45. Yes, second week in a row. Likely not.
Where do we go this week?
I think it falls a bit. I don't know how far, but I do think it slips slightly. We have our Outbound Tender Rejection Index, which is an index of capacity and carriers' willingness to accept loads at contracted rates.
Mm-hmm.
That's falling down. Off of its holiday high, which is
14%.
Normal. Which is really normal.
It's just down to 9% right
now.
Yeah,
somewhere like 9 or 8,
which is
still good. Still
good.
Better than the vast majority of 2019.
It's a 7-day average, so it's coming down.
So let's just give them a little bit of explanation on why that falls, why it gets so high around the holidays, and why it comes down. It's pretty simple, but it's just that drivers go home for the holidays, right?
Yeah,
they get off the road.
That's a large percentage. You have those last-minute deliveries combined with vacation and going home for the holidays. So you get that nice bump in rates,
right?
Which Christmas rates, right? So you can take that home and have a good Christmas. And really, that's the end and short of why Q4 is, or why that holiday peak season is called the holiday peak season.
Right.
Yeah.
And I do think we go a little bit lower, but currently we're sitting pretty for the carriers comparatively for the majority of 2019.
We're going to have good comps.
We are going to have good comps.
At least through the first 6 months of the year.
Right.
We're going to have good comps.
The spread between contract and spot pricing right now leads our tender volume index, at least, to look good for the first few months. Because, we had the opposite last year where spot rates were still a little bit above contract rates in that first couple months while they were pretty much reversing. And that makes people go to the spot market. But
so on the shipper side, you did the shipper update this morning.
We did.
On FreightWaves Now.
Yep.
What did you talk about?
We talked about the PMI ISM Manufacturing Index, the one of the base manufacturing indexes that we have in the U.S. And it's basically a survey they do of manufacturing executives who buy or supply raw products to industrial production.
Like Cliffs.
Like Cliffs, exactly like Cliffs. And so it's one of those above 50, over 50 equilibrium indexes, where above 50 would be expansion, below 50 is contraction, and now we've been below 50 for 5 straight months. We've contracted 5 straight months in a row, and now we're sitting at 47.2, which is the lowest the lowest the index has been since we came out of the Great Recession.
And that's negative news for the pricing, or this DHL supply chain pricing pricing power index.
Yes, it's kind of negative for both, really, especially for the shippers, though,
Yeah, definitely.
because they're the ones they're the ones supplying that stuff.
What else did you talk about?
We also talked about consumer sentiment. So I did a little bit of a tale of two economies right now. You have this industrial and manufacturing economy that's been in the gutter for all of 2019 for the majority of the time, and you had a really roaring, powerful consumer economy, and retail sales are up almost 4% year over year. So you have a really happy and confident consumer, but their confidence may have peaked in the summer of 2019. So you kind of have a troughing, what we think what could be a troughing of the industrial economy and a peaking of the consumer economy, which will likely converge to slower growth, but growth nonetheless in 2020.
Very good, very good. So let's go back to, or basically move on to our last section.
That's right, the long short.
The long short. So basically, are you positive or long something, or negative short something? And we have two of these. So we're going to start off with Boeing. So you have Boeing, the 737 MAX debacle. There's rumors coming out that Berkshire, Mr. Warren Buffett, and Charlie Munger are going to take a stake today. And I believe that's equity, right?
Yes, it's an equity stake, yes.
And I heard something else where they were trying to raise debt as well. I don't know if that's in connection with this at all, but Warren Buffett is buying into Boeing.
Yeah, that's
what does that tell you?
That's the rumor. One, it tells me that, well, it's a few things.
Well, are you long, short?
Long, short, yeah.
And then what are your thoughts?
I'm long Boeing. I still think Boeing is a great company. I don't think that they are, I think they can have one huge mishap in the 737 MAX. I think they'll eventually get it resolved. Got some? I'm just hoping. I'm hoping that the French company Airbus doesn't take too much market share during that time. That they don't replace too many Boeing flights. But I do think Boeing. Can come back
that's interesting. Do you think they're too big to fail?
Ooh, $200 billion market cap.
Well, I mean, but like what you have the financial part of that equation, right? And then you have the government part of that equation. Is Boeing too big for the U.S. federal government to let fail?
No, I don't think I don't think the U.S. government would let them fail. I think they're too big to fail.
I agree,
and I think they also have too many defense contracts to. I think the Army and the Navy needs them, so I don't think they're going anywhere.
Yeah, because usually you have like one major airline manufacturer in a market, right?
Mm-hmm.
So U.S. is Boeing, Europe is Airbus,
right?
And I forget what Asia.
Yeah, I'm not sure either. I know they buy a lot of Boeings, but I'm sure they do.
I think they're trying to create their own. But you have Boeing and Airbus in a deadlock. Mm-hmm. Certainly the Europeans aren't going to let Airbus fail.
No,
right? They've subsidized Airbus for quite a while. So Boeing is, I think, too big to fail.
Yeah,
they'll never let fail.
And it's very rare that Warren Buffett makes a misstep and invests in the wrong company. So if Warren Buffett,
we did talk about his misstep with Kraft Heinz,
yes.
but that play isn't over yet.
No,
but that's in an earlier episode.
Yes,
yeah,
I think it was episode 6. You guys
go
check it out.
Yeah.
All right. So you're long as well.
Yeah, I'm long. I basically just the odds. Buffett doesn't. He knows what he's doing before he does it.
Yep.
He knows all the cards, right? I think, basically it's too big to fail. It's too big to fail. And I think there's bad news, but it's not catastrophic news anyway, that you're buying cheap. You're buying on bad news that is not terminal, but it's just bad. And it would probably be bad for a while. So it's a good entry point. So I'm long that decision as well. Definitely.
Good.
And
we got one more.
We got
a fun one.
We do, yeah.
My Titans just took them out this weekend.
I know. The Tennessee Titans beat the New England Patriots this last Sunday.
There's a lot of Ravens fans in this building, too, so I'm going to have to come in with my mouth on straight.
I know. There are a lot of Ravens fans running around here. So New England Patriots, is the dynasty over?
Long or short? I am.
Long or short, yeah.
I'm long that the dynasty's over. I'm short the New England Patriots in the near to midterm. I think I don't know if that was the last pass that we see Tom Brady throw in New England, but I think Josh McDaniels, his OC, I think he's gone. I think he might go to Cleveland actually.
Yeah.
So I think that for the meantime, I think that the dynasty is over. I don't see them making another AFC Championship or a Super Bowl in the next few years. They're tough, but they're gonna have to take a step back.
I agree with you. I think it is the last pass Tom Brady throws in New England. I think the dynasty is over. at least for 2 or 3 years.
I mean, Bill Belichick is still a great coach, and I mean, he'll be back. But
so if you get the right pieces together, you can make a run. The defense is still great.
Yep.
You probably need some wide receivers.
Probably need to learn how to stop Derrick Henry.
Need to do that. That's tough to do.
Can.
I know, right? He's a big guy.
Yeah.
So I think the dynasty. I think it is actually over. But it could just take a pause for 2 or 3 years as they rebuild a little bit, retool, get the pieces together. But is Belichick going to be around in 2 or 3 years himself? I mean, it's time.
It's true.
He might want to retire as well. So
how about this though? How about I read something earlier that said this could be the greatest coup ever created. That your Cleveland Brownies, they go and get Josh Daniels and they go and get Tom Brady on a 1-year contract. You think that's capable? I know you're a Baker fan, so
I'm a Baker fan. That's the only reason
I think
why
Baker needs somebody to come and cool him down for a little bit.
He needs something.
Season.
Cleveland Browns need something.
Yeah.
They need a whole new organization. In a lot of ways, but yeah, I'm a Browns fan because of Baker Mayfield. I grew up a Dallas Cowboys fan, which is a dysfunctional organization.
Mike McCarthy, that might be a good hire. You think that's a good hire or the safe hire?
You know what? Jerry's going to he's going to ruin everything. he just will. His ego will take over.
He's getting up there too,
and
that's he'll have to pass it off soon.
He will definitely. So, but that's going to wrap us up. You can listen to us on podcasting stations like iTunes and Spotify. On FreightWaves.com. We'll have this posted in a couple of hours, so you can go to there. Go to YouTube. You can go to a lot of different places, and as well, no matter when you're watching, if you want a PowerPoint of Cleveland Cliffs, AK Steel, some financial information, some SWOT analysis, kind of the research we used to build this, then Cahill at FreightWaves.com, KHILL at FreightWaves.com. We'll send you a free copy. And that will do it for this episode of Great Quarter Guys.